Hello friend, how are you? I'm creating this video to teach lot of people about what is the deferred tax asset and deferred tax liability. The objective of recording this video is to provide awareness about the topic called deferred tax asset and deferred tax liability. Earlier we have accounting standard 22. In India, earlier we have accounting standard 22 for accounting of deferred tax asset and deferred tax liability, which talk about how to recognize the deferred tax asset and deferred tax liability into the books of account and how to present it into the financial statement. However, now we have IND AS 12. Now we have IND AS 12 in India and IFRS 12 globally. So IND AS 12 or IFRS 12, there are certain slight differences. Majority, the underlying objective of both all the three standard I'm talking about, accounting standard 22, that is earlier Indian GAAP, and the IND AS 12, that is accounting for income tax, that's the IND AS converges to IFRS, and IFRS 12, that again accounting for taxes. Let me tell you, there are differences in all these three standards. There are differences in all these three standards, but the basic idea of development of these standards remain the same. Matlab, for what perspective, the underlying objective of creating accounting standard 22, index 12 and IFRS 12 is nowhere different. However, they have different approach. However, index 12 and IFRS 12 have different same approach, but accounting standard 22 and index 12 have different approach. But I am again want to make you very clear the underlying objective of creating this standard remain the same. So friends, I am here to tell you why this standard is there. I think if you will get an idea why this standard has been developed to show the true and fair view of the financial statement, so I think you would have better idea about the application of this standard. So let me tell you, if you are out of from India, you can also watch this video because IFRS 12 is slightly similar to IND AS 12. So this video will help you to identify, this video will definitely help you to identify and understand how to create the deferred tax asset and deferred tax liability. I know there is lots of dilemma. There is lots of dilemma if you're a professional, if you're a student. So there is lots of dilemma about the understanding the temporary differences. Earlier accounting standard 22 in India, earlier in accounting standard 22 in India was based on income statement, yani ki P and L account. But now the IND AS 12 and the line with global standard IFRS 12. Now it's basically it's a balance sheet approach standard. Now it talks about the identification of temporary differences. Now it talks about the identification of temporary differences. First, so friend, I would like to introduce myself to you. Sorry, I forgot to introduce myself is CA Lanesh Patil. I am actually a trainer in IND AS and IFRS. So I also train CA students for their professional exam. So friends, you can just see on my screen. You can just see on my screen that there is some chart of IND AS. So I am having the chart for all the IND AS. And let me make you very clear. The objective of this video is not to teach IND AS 12 entirely. The objective is this video is to simply make you very clear about the identification of temporary differences, and if the temporary differences are there, so how to create the deferred tax and asset and liability, that I will also discuss. But apart from that, I am not going to discuss it too much, that you can see in this chart. I think that lots of people are facing the difficulty after the introduction of IND AS after the convergence of IND AS to their company, and the lots of people out of India are also facing in the application of IFRS 12 to identify the temporary differences to create the DTA and DTL. Sometimes they are a little bit confused. What is the temporary differences? What is the tax base of asset? What is the tax base of liability? What is the carrying value of asset? What is the carrying value of the liability? So for that purpose, I am here to help it out to you. I will discuss the pure objective of this standard. So let's start with this, friends. Why IND AS 12? Why IND AS 12? Again, let me tell you. If I talk about accounting standard 22, if I talk about IND is 12. If I talk about the IFRS 12, okay, these all standard are accounting for taxes, okay. As I said, my objective is not to teach entire Index 12 here. The people understand what is accounting profit, what is taxes and profit, what is current tax. But still, I will have some, I will put some light on this topic also. But actually, what I mean to say, let's start me. Whatever, if we talk about accounting standard 22, if you talk about Index 12, if you talk about Index 12, IFRS 12, I said the basic idea of these standards remain the same. Okay, so let me tell you something. What is that idea? The idea is matching concept, friend. The idea is matching concept. This video will definitely and surely help you to solve various problems if you are a student, and if you are a professional it will definitely help you to identify the temporary differences and create the deferred tax asset and liability for your organization. Okay, so let talks about the matching concept. The entire idea when they develop AS22, when they talk about the IND AS 12, when they talk about the IFRS 12, the entire idea is matching concept. What is the matching concept? Let me tell you. Although the IND AS 12 and the IFRS 12 has a balanced sheet approach, but still I want you to learn this via the income statement approach. This will help you to identify and create the lots of things. First of all, I will tell you something. I think you know there are two types: IND AS 12 and IFRS 12. Talk about the temporary differences. Index 12 and IFRS 12 talk about the temporary differences. Okay, now the temporary differences are of two types. They talks about the two types of temporary differences. Let me tell you. They talks about the two temporary differences. Let me tell you. Taxable temporary differences. Taxable temporary differences, and they talk about deductible temporary differences. What I mean to say, they talk about the two types of temporary differences. You carefully watch this video. This video will tell you how can you identify and sum up the entire standard in a very short duration. Okay, so let's temporary differences are of two types. That is called the taxable temporary differences. Taxable temporary differences mean in future you are going to have taxable profit. It means you need to pay taxes in future. Okay, and the deductible temporary differences, it means you are going to get the benefit in future. If you are going to benefit in, you are going to have a benefit in future, this will save your taxes in future. So what index 12 and what index 12, sorry, IFRS 12 talk about this is for taxable temporary differences. For taxable temporary differences, you need to calculate deferred tax liability. And for deductible temporary differences, you need to calculate the deferred tax asset. Okay, you need to calculate the deferred tax asset. First of all, I am starting like you have read in Indus 12 or IFRS 12. They started like that. You need to create a deferred tax liability if you have taxable temporary differences, and the approach to identify the taxable temporary differences are the balance sheet. I will discuss all these things. Okay, and you need to create a deferred tax asset if you have deductible temporary differences. I will surely, I am telling in the language of the books earlier you have read from your book, because first of all I need to tell you what the book says, then I will tell you my understanding and my grasping to make the subject very clear and very easy to you. Okay, so you need to calculate the deferred tax liability, you need to calculate the deferred tax asset. Temporary difference. When you have taxable temporary differences, when you have taxable temporary differences, I tell you when when the carrying value of asset is greater than the tax base of asset, you have temporary taxable differences. Okay, you have taxable temporary differences. I will surely make it easy also. Just have a patience for you. Tax base of liability is greater than carrying value of the liability. What is the tax base? What is the carrying base? That is the phenomena of this standard. Why this standard become tough to apply? Is a pure the main theme line is the understanding is what is the tax base and what is the carrying value. I feel that most of the time the student or the professional do not feel difficulty in identifying the carrying value of asset and liability, because the carrying value of the asset and the liability has to be taken from the financial statement. There is no tough call in that. But what I feel students or professionals feel some faces some challenges and problem in identifying the tax base of asset. That is a typical key for the student and the professional. So this video will definitely help you to identify the tax base of the asset. Okay, and if you make the reverse situation, so that will be like this. Reverse. Okay, it means the carrying value of asset is less than the tax base of asset, and the second situation is like this. The carrying value of the liability. Okay, I hope so ki you guys have already learned this. I hope so you guys have already learned this and you know about it. I believe so ki you are very much clear about these things. Ki what when you have a taxable temporary difference, when you have deductible temporary differences. For a better understanding, I will give you an idea. Let me take this. For example, you have a balance sheet of accounts like this, and you have balance sheet of tax like this. Okay, sorry, sorry. Now you have asset in account. Okay, now you have asset in tax. We know that the accounting goes by company law, the corporate law, and the applicable financial reporting framework, that is mostly the INDs and IFRS. Okay, but the tax base is something else, because the tax provision are slightly different. They allow the deduction, they made some income taxable, and taxation rules are quite different from the applicable financial reporting framework for reporting for making the reporting of the financial statement to the various users of the financial statement. Okay, so what I need to say is the asset, the book value of asset as per the accounting record and the book value of the asset as per the tax record will be different. Treat it as an income. When you have balance sheet, when you have balance sheet of the books of where when you have balance sheet of your financial statement balance sheet, you will treat the asset as a income. Treat it as a income. Why? The asset balances of the tax will be treated as an expenses. Treat it as an expenses. Now you can clearly understood. I have wrote down the taxable temporary differences. You need to create the TTL. For example, the carrying value of asset is higher than the tax base of asset. So if you treat the carrying value of the asset as an income and tax base of the asset as a expenses, and if your income is higher than expenses, it means in future you are going to pay taxes. For example, if the carrying value of the asset is 1200, it means it is your income. It means in future, if you will dispose of the asset or you will use the asset, will have an income of 1200 in the future. Okay, and if you have the book value of asset in the taxation accounting is 1000, it means when you will sell asset at 1200, you will when you will calculate your capital gain, you will say I have sold the asset for 1200 and minus the book value of asset is 1000 for you. It means in future you are going to have a taxation of 200, profit of 200. Accordingly, the 200 ka 30% you have to pay the taxes in future. So India's 12 and IFRS 12 says that you need to create the deferred tax liability for that. Okay, so I believe that this will literally help you. And if there is a situation in the reverse, for example, if the carrying value of the asset is 1000 rupees and the tax base of the asset is 1200 rupees, it means in future you are going to have an income of 1000 and the expenses of 1200. It means you are going to have a losses in future. And if you are going to have a losses in future, it means you will have the benefit. You will save your taxes in future. If you will save your taxes in future, you need to create the deferred tax asset today. Okay, you can check it out. The carrying value of asset is less than 1000 is less than 1200. That is the tax base of asset. You need to create a deferred tax asset. I believe you are getting this. You are getting this. But definitely, whatever I'm telling you now, this is again it may be one side of the coin that you can think like this. Another side of the coin I will produce. Whenever you read the books, you have the same idea. Might be I simply change the thing, like you treat the carrying value as a income and the carrying value of the tax base, sorry, the tax base of the asset treated as a expenses. Okay, now the carrying value of the liability treated as an expense. Reverse. For asset and for the carrying value of the asset, you treat it as an income. Now the carrying value of the liability, treat it as a liability. Sorry, expenses. and it is easy to remember. The carrying value of the asset is an income, then the tax base of the asset is a liability. So if the carrying value of the asset is an income, so the carrying value of the liability is an expense. You can simply make it reverse. Now you can try it again. If the tax base of the liability is higher than the carrying value of the liability, if the tax base of the liability you treat it as an income is higher than that the carrying value of the liability, you treat it as an expenses. Okay, so now in this case you will have an income in future. If you will have an income in future, you need to record the liability. You need to create a deferred tax liability. I believe so ki whatever discussion we have made till right now, you are able to understood it. This is simply what you have learned in your Index 12. I'm saying ki this lecture is not here to define you, tell you the entire Index 12 or IFRS 12. This lecture is only there to help you to understand how to identify the carrying value and the tax base of the asset. Okay, okay. Now, whatever till now I have discussed, this is somewhere very much related to what you have learned in the books. The different thing that I would have told you might be treat the carrying value of the asset as an income and the tax base of the asset as an expenses. That may be the different thing. But also, but till now, the things are different. Now, what I mean to say. Now I need to focus into the P&L, now the income statement. Then friends, I will use this module. Actually, if you are from India, you know the ICI, the Institute of Chartered Accountants of India. So they have actually developed this particular standards, and actually it is also a part of the Chartered Accountancy CA final curriculum. Okay, so I have taken their module for the reference to identify the various example. It is various example because this video is also going to provide the CA finalist student, and also the professional in India and outside of the India will also take the advantage of this particular video to identify how to know the carrying the tax base of asset and liability. As I said, the carrying value of the asset and the carrying value of the liability ko janna, to know it is not typical. The typical task is to identify the tax base of asset and liability. So we will use this particular sheet also, but right now I am coming here. In the starting of this standard, I says the AS22, IND AS12, IFRS 12, the entire objective is matching concept. The entire objective is matching concept. For the matching concept, this standard has been developed. Okay, so what I mean to say, say for example, it's your financial statement, it's your P&L account, P&L account, P&L account, accounts, not of tax. I believe the expenses are recorded at two sides, and income is written at buy side. Okay. Now, what is the matching concept say? Matching concept says that if you incurred an expenditure, now carefully watch this video. Matching concept says that if you record any expenses, and if that expenses is entitled to have the tax advantage, it means what I mean to say, the tax advantage, if you record any expenses and if that expenditure is allowed in the income tax act for the tax purpose, it means to calculate the taxable profit. It means any expenditure which is allowed as a deduction in taxation is basically going to bring the tax saving for you, and the tax saving for you is an asset. If you are going to have that tax saving in the current year, it will automatically adjust it in the current tax. But if you are not going to have that tax saving in the current year, but you are going to have that tax saving in the coming year, it means on the line, it means you are going to have tax saving, that is confirmed, but you are not going to have tax saving in the current year. So IND AS 12, accounting is unit 22, IFRS 12 say if you have incurred an expenditure of 100, if you have an expenditure of 100 and you are going to save your tax, you are going to save 30 rupees of your tax, it means the net of tax expenditure is 70. If because of incurring 100 rupees of expenditure you save 30 rupees of your tax, it means the net expenditure to your organization is 70. If you are going to have this tax saving advantage in the same year, so this tax saving is automatically get adjusted into the current tax, okay, करंट टैक्स में एडजस्ट होएगा. If but if you are not going to have this benefit in the current year, but you are going to have the benefit in the future year. So in days 12, age 22 and IFRS 12 says, if you have recorded the expenditure of rupees 100 in the current year and you are going to have the benefit in the future year, and if you will recognize the benefit when you will receive the benefit, so it will be a violation of the matching concept. It would be a violation of the matching concept. You are recognizing the expenditure of 100 and whatever saving you are getting because of 100 has to be recognized in the current year if you are going to have that saving. And if you are already recording that saving in the current year, there is no concern of deferred tax assets or deferred tax. Okay, the concern of the deferred tax arises when the related benefit on the expenses are not recorded in the current period. Then you need to bring into the current period by recognizing the deferred tax asset. Therefore, you pass the entry deferred tax asset account debit to P&L. So automatically in P&L side that will be credited. Okay, what I mean to say, try to understand my concern here. I say the P&L account. I will be simply saying at the P&L account in the financial statement you have recorded the expenditure. Now I will ask three questions, and you can simply carry it out. Huh? Very carefully. I think you need to see it very carefully, then it will be very easy for you to identify the carrying value of the asset and liability, है ना? Just be with me in this video. Is this expenses deductible? Because if you have incurred an expenditure of 100 and this expenditure is deductible in income tax, you will have a benefit. If it is not deductible, you will not have benefit. Okay. So now there will be two answers. One is no. If the answer is no, ignore deferred tax. Ignore deferred tax. If the answer is no, ignore deferred tax. What I mean to say is the matching concept says if you have recorded the expenditure, related benefits must be recorded in the same year. If you have recorded an income, the related tax expenses must be recorded in the same year. If you have benefit, if you have tax liability, then if you do not have, ignore it. Now, is this expenditure deductible? No. Ignore deferred tax. If is this expenditure deductible? Yes. Now there are two questions. Is this expenditure deductible? No. Ignore deferred tax. Is this expenditure deductible? Yes. Now there are two things. In current year only, it means this expenditure is going to bring tax benefit for you, and in the current year only. Okay. And the second, no need to create deferred tax. No need to create deferred tax because benefit already been accounted in current tax. It means while calculating the current tax is calculated on taxable profit as per the income tax law. It means while calculating the current tax, you calculate current tax based on taxable profit, and while calculating the taxable profit, you have already reduced this expenditure. It means you have already made your profit lower. Accordingly, your taxes are always lower. It means if any expenditure, is this expenditure deductible? No, ignore it. If yes, in current year only, no need to create deferred tax because the benefit have already been accounted in the current tax. Okay, now if it is going to be in the coming year, now create deferred tax, create deferred tax to match benefit with expense, to apply matching concept. It means now create the deferred tax to match the benefit with expenses, because you have to simply apply the matching concept. If suppose that if you have incurred 100 rupees of expenditure which is not allowed in the income tax, which is not allowed in the income tax for the deductible purpose, so if you will if you need, you simply need to ignore it. You simply need to ignore it. Say no need to create the deferred tax asset and liability. You need not to create the deferred tax asset and liability because you are not going to have any benefit. You record the deferred tax asset because the benefit you are going to have, but the benefit you are going to have in the future. So if you are going to have the benefit in the future, but you need to record the benefit today in line with the matching concept. So you actually need to record that particular thing. Okay, I believe you have understood it. I believe you have understood it and you are getting it. Okay. Now we have expenses. Now we have income. Now the income. Now we need to ask a question. Now we need to ask a question. Is this income taxable? Is this income taxable? Is this income taxable? Now you will have two answers. No and yes. Now if you have no, again same. If you have earned 100 rupees and this income is not liable to tax, it means if you have earned 100 rupees and this income is not liable to tax, it means your income is 100 even before tax and even after tax. Okay, so you need to create you need not to create any deferred tax. Okay, so no, ignore deferred tax. Ignore deferred tax. But if the answer is yes, then now you need to ask a two questions. The same thing. In current year, so again the answer is same, or in coming year, again the answer is same. But the difference is that you need to create now deferred tax asset and deferred tax liability. Okay. So now in that case you need to create the deferred tax asset, and in this case you need to create the deferred tax liability. So now yes, in current year, now it is in current year. In current year, I do one thing. Why I should write it again? Okay. I think you have understood. I hope so. So this is the basic idea of IND 12, Accounting Standard 22, and IFRS 12. Basically, they want to match. They want to match if your expenses. So if this is measured very easily, huh? When you create the deferred tax asset, and suppose that if you have incurred 100 rupees of expenditure, which is going to be allowed for the deduction in the coming year, not in the same year. It means you are going to have the benefit, but this benefit will be reaching to you in the coming year. but the expenditure has been accounted on accrual basis in the current year 100, and if you are going to have the benefit, you need to make the benefit in the current year only, but you will receive this benefit in the future. That's why you will not adjust it into the current taxes. So therefore we have a concept of deferred tax. The concept of deferred tax is to bring the current taxes equal to the in the line of matching concept. Okay, so I hope so you have understood this. Now how you can apply this particular formula to understand the tax base of various assets and liability. Very simple. If suppose that if I say ignore deferred tax, so it means you will be ignoring the deferred tax when the carrying value and the tax bill will be equal, because the deferred tax is created for the temporary deductible and taxable differences. If there are no temporary deductible and temporary differences, it means there will be no deferred tax asset or liability. So it means you simply need to understand, if any item of expenditure is not allowed for deduction purpose, and if any item of income is not taxable in the future, then its carrying value and tax base has to be same. You can apply this fundamental to understand the various terminology, and also to understand, you need to simply understand whatever income you are recording, the related tax liability must be recorded in the current year only, whether it is going to be taxable in the future or whether it is taxable in the current year. If it is going to be taxable in the current year, the tax liability will be automatically recorded by way of current tax, and if it is going to be taxable in the future, you need to record the tax liability by way of deferred tax liability. Is that clear? I hope so. Just break. Yes, friend. Now we will talk about. Actually, we understood that you need to create the deferred tax asset and liability when there are temporary differences. It means you now what idea you would have. If you know that there are no tax benefit or there are no tax liability in the coming year, and actually it is not liable to tax anymore. Okay, this amount is not liable to tax anymore. Accordingly, you need to keep your carrying value and the tax base is equal to. Accordingly, you can decide what should be the carrying value and tax base of that particular asset and liability. For that purpose, now we will look some example. Just a minute. Now, I will simply take some example and will try to understand. For example, when you talk about the property, plant and equipment, so actually the difference you say the carrying value of the asset, and I don't find there are lots of difficulties in understanding that. But in fact, that difference also arises due to the depreciation method, because in most of the financial statement you will find the SLM or WDV method, and the rate of depreciation differ from the what you charge into the income tax act. Okay, so that's why the differences arises, because in for example, might be in your books of account you have claimed 1000 rupees of depreciation, but in income tax earlier you are being allowed only 500 rupees. For example, it means that now 1000 rupees you have recorded as a depreciation expenditure, that it means that by way of 30% you are going to have a tax benefit of rupees 300, but in current tax you are getting the benefit at the rate of 30%. It means you are going to getting the benefit of 150. So it means if you have incurred an expenditure of 1000 rupees by way of depreciation, and you are going to have a tax benefit of rupees 300, out of that rupees 150 benefit you are getting in the current year, but 150 benefit you will be getting in the coming year. So on the line of matching concept, if you are going to have the benefit of 300, and out of that 300, 150 had already been accounted into the current tax, so remaining 150 need to be accounted by way of deferred tax asset. That's why you get the difference of two value, that is actually the difference of depreciable amount. If you find it, you can simply check it. or I can tell you also. Look at Entity A acquired an item of plant and machinery for rupees 1 lakh on 1st April 2001. It depreciated this item at the rate of 10% per annum on SLM basis. For the year ended 31st March 2002, it provided depreciation of 10,000. The carrying amount of this item of the plant and machinery as on 31st March 2002 is 90,000. As per the taxation law, this item of plant and machinery has to be depreciated at 30% per annum on WDV basis. The entity thus for the purpose of taxation compute the depreciation 30,000. The tax base of the plant no. Let me tell you. Carrying value of asset minus tax base. Now look at the carrying value of asset is 90,000, but the tax base of asset is 70,000. Now, if you will look at from the perspective of India's 12 language or IFRS 12 language, it means this is your income. I said the asset is an income in accounts and the asset is a expenses in tax. Now, it is your expense. It means in future you are going to have. It means in future you are going to have 20,000 rupees of profit, and if you are going to have 20,000 rupees of profit, you need to create at the rate of 30% 6,000 rupees. You need to create a deferred tax liability. Okay, this what I am telling you ki Ind AS 12 talks about or IFRS 12 talks about. Now let me tell you in my language also. In my language you will simply record the depreciation of 10,000. Okay, but in income tax you will be claiming the depreciation of rupees 30,000, and accordingly you will be getting the benefit of 9,000. It means on the line of the matching concept, if you have recorded the expenditure of 10,000, it means on the line of the matching concept you have recorded the expenditure of rupees 10,000 and the related benefit must be accounted as 3,000 rupees. Okay, but you are getting recorded, but the benefit you are recording in incorporating into the current tax is 9,000 rupees. It means 10,000 rupees if your expenditure and you are going to have 30% of the benefit, it means you must record the benefit of rupees 3,000 rupees. Okay, but actually you will be claiming the depreciation benefit as per the income tax law of rupees 9,000 rupees benefit. It means you are getting the benefit of 9,000 which is already incorporated into the current tax, but you need to record the benefit of 3,000. It means the benefit must be accounted as a 3,000, but you have already recorded the benefit of 9,000 rupees. So now you need to reverse the 6,000 benefit recorded, that you need to give a debit. It means you need to record 6,000 rupees as a deferred tax liability. I hope so you understood. It is simply a matching concept. The matching concept says if you are going to have benefit, if you are going to have a liability, and if you are not going to have, ignore deferred tax. If you are going to have, and if you have recorded the same amount that you are going to have, no problem. If you have recorded any amount excess or lower, so you need to adjust it by making the recording of deferred tax asset and liability. For example, you are not going to pay any taxes, ignore deferred tax. You are going to pay 3,000 rupees of taxes and you have already recorded 3,000 only, no issue. But if you are going to pay 3,000 rupees but you have recorded 1,000 rupees or you have recorded 5,000 rupees, then you need to make the adjustment. What I am telling you, the friend, you need to keep in mind the matching concept. If you recorded any expenditure, whatever amount of expenditure you recorded into the books of account, the related tax benefit should only be accounted into the books of account. If you have got the benefit higher, so you need to reverse that benefit by creating the deferred tax liability, and if you have recorded the benefit lower, you need to increase the benefit by recording the deferred tax asset, and same for the income side. I hope so friend, this will definitely going to help it out to you. Okay, now come read this question. Entity A has an inventory with carrying amount of rupees 1 lakh, because the Ind AS 12 and IFRS 12 has an asset batch of balance sheet approach. Therefore, I will definitely help it out to you to identify the differences in my understanding. है ना? The entity A has an inventory with carrying amount of 1 lakh as a reporting date. It recovered the value of inventory through the sale in the subsequent. Up simple. Now, the inventory 1 lakh is your asset. Inventory of 1 lakh is your asset in the balance sheet, and in my language it is your income. And now you pay the taxes on this income when you earn this income. If you purchase the inventory, you are not liable to pay taxes. You are liable to pay taxes when you sell the inventory and generate the income. It means in accounting this income has not been recorded because you have not sold the inventory. In taxes also this income has not been recorded. So try to understand. In accounting this is not income has not been recorded because it is still your asset. In taxation, the income has not been recorded. Okay, so why? It means simply, if you have not recorded any income in accounting, you need not to account for any taxation effect. Okay, so how it is possible? When the tax base and the carrying value is same. So that is the tax base in this case is 1 lakh. What I mean to say, if in accounting you have not recorded any income, if you would have recorded an income of 1 lakh, so I would have said that the tax consequences of 30,000 rupees should also be recorded. But if you have not recorded any income, so the question of recording the tax base is also not arising. However, if still you would be recording any taxation effect, then we need to adjust it by way of creating the deferred tax asset and deferred tax liability. Okay, so in this case the tax base is 1 lakh. I hope so you would have clarity on this. Now I have a different example. Entity A has acquired an item of asset 1 lakh for production of certain item to be sold by the entity. It is deductible equally over the 2 years in the books of account. The carrying amount at the end of the first reporting period is 50,000, and in income tax 75,000 is deductible in 1 year and balance is deductible in year 2. We have to compute it tax based on the last day of the first reporting period. Now you can simply do it, because in asset I don't find that anybody got into the problem. But in as per my opinion, as per my understanding, this will help you a lot. 1 lakh, if you are going to record in accounting 50,000 rupees as an expenditure, it means you record the benefit by way of say for example 30% is the tax rate. Say for example the tax rate is 31. It means the benefit must be 15,000. But actually in income tax you will be claiming depreciation of 75,000. It means you will be claiming the benefit of 22,500. Okay, if you will be required to create the benefit of 22,500 rupees, okay, it means you are recording the excess benefit of rupees 7,500 rupees. For that purpose, you need to create the deferred tax liability. A deferred tax liability of 7,500 rupees will be recorded at the rate of 30%. It means there must be it is equal to 0.30. It means there must be a temporary difference of 25,000. और 25,000 का difference अभी कब आएगा? जब ये 50,000 होएगा और tax base कितना होएगा? 25,000. So I hope so you would have understood the tax base in this case is 25,000 rupees. Okay, now. Interest receivable have a carrying amount of 100. Interest receivable, it means some interest income has accrued. It means some interest income has accrued, because in accounting we record the income or expenses on accrual basis. It means some interest income has been accrued of rupees 100. The related interest revenue will be taxed on case basis. Income tax में case basis पे. Okay, so now try to understand. It means if I have recorded a income of rupees 100, and say for example I have to pay 30 rupees of tax, but in income tax I have to pay the taxes when actually this income will be realized. So I said ki it is okay. The IND 12 and IFRS 12 says that on the line of the matching concept, the related benefit and related liability must be recorded with the income and expenditure. So if the income is 100 and you supposed to pay 30% tax on it, so it means liability of 30 must be recorded either by way of current tax or by the way of deferred tax liability. If this income would be taxed in the same year, then you would have recorded the tax liability of rupees 30 incorporating into the current tax. But in income tax, this income is not taxed in the current year. It means the liability of rupees 30 will not be included into the current tax. So you need to create a deferred tax liability of 30. Now, the deferred tax liability is created. Deferred tax liability is created on the carrying value minus tax base. Okay, and when the carrying value, it is an asset. So when the carrying value is if rupees 100, because receivable is 100, if you will take the tax base of 100 as an asset, यानी कि income tax may be same, either be same. So actually it will become a zero. So accordingly there will be no temporary difference. There will be no tax liability. So if you want to have a deferred tax liability of 30, if you want to have deferred tax liability of 30, then definitely to have a deferred tax liability of 30 you need to have temporary differences of 100, and temporary differences of 100 will be arises when the tax base of any asset is 0. So it means the tax base of asset in this case will be nil. So I hope so you would be understanding it. So try to understand. Actually, I want to record the tax consequences of income and expenses in the same year when that expenses or income are accounted in the accounting book with the same amount. If that is not being the case, then I need to create a deferred tax asset and deferred tax liability. Okay, so I can simply tell you when to create a deferred tax asset and liability. Now, for that purpose, you need not to look into the balance sheet approach. But still, I am telling you कि if you are finding any difficulty to identify the tax base of any asset or liability, you can use this approach to identify. Okay, now look at the second case. An entity that followed the mercantile system of accounting has trade receivable of 1000. It creates a general bad debt allowance of 150. Now, please let me know. Now, in P&L account, if your books of account, you will be recording an expenditure of rupees 50. Okay, 50. However, in income tax, the general bad debt provision is not deductible because the income tax says we will not allow the benefit of bad debt until you incur the bad debt. But in your books of account, you have recorded the provision of 50. And suppose if you have a tax rate of 30%, it means if suppose in future you incurred a bad debt of rupees 50, you will be getting the benefit. It means this expenditure is liable for getting the benefit. It means this expenditure is liable for getting the benefit. If the expenditure is liable to get the benefit of 50, but income tax will not allow the deduction in the current year because the actual bad debt has not taken place. Accordingly, the current tax will not consider the benefit of 50. Accordingly, the current tax will not consider the tax benefit of rupees 15. So you need to create the deferred tax asset. And to create the deferred tax asset, you need to create the deferred tax asset. And deferred tax asset is created. And the deferred tax asset is created when the tax base of any asset is higher than the carrying value of any asset. Okay, tax base of any asset is higher than the carrying value of any asset. So if the carrying value of the asset is 950, then to create 15 rupees of deferred tax asset, you need to have a temporary 15 is equal to 0.3. It means you need to have a deferred temporary differences of 50. So if your carrying value is 950, then definitely you have to tax base of 1000 rupees. Are you getting my point? Are you getting my point? Now I hope so. Now you understood it. Okay. And now the next example. An entity that follow the mercantile system of accounting had trade receivable of 1000. It create a specific bad debt of 150. The carrying amount in the books of account of the trade receivable is thus 950. However, in income tax, specific bad debt provision is deductible in the very year it is created. Now look at it. It means income tax act says कि now we will allow the deduction of bad debt when you create the provision. It means to get the benefit of bad debt you need not to actually have the bad debt. It means if in accounting you have record the 50, you need to have a benefit of 50 and you will get that benefit of 15 incorporating into the current tax. I said na, please look at I said, if any is this expenditure deductible? Yes. So in current year only? Yes. Because income tax is allowed in current year, no need to create the deferred tax because the benefit have already been accounted in the deferred tax. जबकि previous example में create the deferred tax to make the benefit with expenses. Now. If you don't want to create the deferred tax, and the deferred tax will not be created when you do not have any temporary differences. Okay, if you have temporary differences, you need to create the deferred tax, and if you do not have the temporary differences, you need not to create the temporary taxable. So if the carrying value is 950 in the books of account, and you don't want to create the deferred tax, it means the tax base has to be 950. I hope so. I hope so. I hope so. I hope so. I don't know whether you are understanding it or not, but I think you can apply that particular form. However, there are certain exceptions to apply this rule. I know, but the theme is same. But what I mean to say, if it means if you have benefit or liability. If you are going to have this much of benefit, or you are going to have this much of liability, minus benefit or liability. Okay, the benefit or liability minus the benefit or liability already considered in current tax. This will give rise to deferred tax asset or deferred tax liability. Now we need know that deferred tax asset and liability is created on temporary differences. We know that it is created on temporary differences, or this is the tax rate. I'm actually telling you some shortcut to identify by going the reverse working. Although I told you very simple, if you do not, if I would be working in a practical life now, I will not be going by the balance sheet approach. I will be simply looking at what is my income in my books of account, and if it is liable to tax, so am I recording the same liability in the current tax? If yes, no issue. If no, I need to give a fact of deferred tax asset and liability for that purpose. Now if you know this much is you need to record this benefit, but you are getting this benefit. If you are getting the higher benefit or lower benefit, accordingly you need to adjust for the deferred tax asset and liability. You will be knowing this. Actually you will be getting the temporary differences. Now you know the temporary differences, how the temporary differences are arise. Temporary difference arises are carrying value minus tax base. What I was doing, I am just sharing with you. Now you know this. Now you know that automatically you will know the tax base of the asset. Or the simple fundamental is very simple. One, you need to apply this trick up to the 5, 6 or 7 example. Then you will understand it. Then you will not to go by this long format. Now read this example. An entity has an investment in listed equity share. An entity has an investment in listed equity share. It means an entity is an asset. And till the time I will sell this investment, I will not get any income into my books of account. It means as on date I am not having any income. It means as on date I must not have any tax liability. Okay, there is no tax on gain that arises on the sale of these listed equity share. It means इसमें कोई अगर अगर कभी कोई benefit आएगा भी, if still you are going to have any benefit of this, you are not liable to pay any taxes. And if you are if it is not, if this income is not going to be liable to the taxes, it means ignore deferred tax. Yeah, remember, ignore deferred tax. And to ignore deferred tax, to zero, to have zero deferred tax asset and liability, you need to have zero temporary difference. And to have zero temporary difference, the carrying value of asset and liability has to be simple. Are you getting my point? If any income or expenditure is not liable to tax, remember, if any expenditure or income is not liable to tax, then deferred tax asset and liability will be zero. And deferred tax asset and liability will be zero when the temporary differences will be zero. And temporary differences will be zero when the tax base of any asset or liability is equal to its carrying value. So let's listen to me. The tax base and the carrying value has to be same. So the tax base on this case will be the carrying amount of the investment. An entity has given a loan of 10,000. An entity has given a loan of 10,000 rupees. Now remember that loan, when you give any loan now, that is not your income. That is purely your an asset. And if you have given any loan, and it's, for example, I give rupees 10,000 rupees of loan to somebody. Whenever I will be getting this loan, so this is not my income. Huh? Although whatever interest I will earn on the same income, same loan will be taxable, will be liable to tax. But when I give loan to somebody and when I will get this loan repaid, this is not my income. If this is not my income, so this should not be liable to any tax. And if this should not be liable to tax, so there is no question of deferred tax asset and liability. And if you do not want to have deferred tax asset and liability, then you need not to have a then you need to have a temporary differences of zero. And to have temporary differences of zero, the carrying value must be equal to the tax base. Okay, so if the carrying value is 10,000, then the tax base also be 10,000. I believe you understood this concept. Okay, now the current liability include accrued expenses with a carrying amount of 100. It means in the books of account we have recorded some expenditure. It means in books of account we have recorded some expenditure, because if we have recorded some expenditure, therefore we have a liability into the books of account now. So try to understand. If I have recorded an expenditure of 100, okay, and I want to have a benefit at the rate of 30% of rupees 30, but income tax, the related expenditure will be deducted for tax purpose on a cash basis. Try to understand. I have incurred expenditure, I have not paid it. In my books of account, I have recorded a expenditure of rupees 100. Come to my chart. Come to my chart. Expenses है, okay. Is this deductible? Yes. It is deductible. Come to this chart. Okay, deductible, yes. In current year only? No. In coming year? Yes. Create deferred tax. Create deferred tax. Up to create the deferred tax, you need to have the temporary differences. And if the carrying value, of the asset is 100, sorry, if the carrying value of the liability is 100, to have temporary difference of 100, the tax base of the liability should be 0, and you will have this. I hope so कि this you would have understood this. I know I don't have much time now to record this video, but I hope so कि this video will definitely help you to identify the tax base of asset and liability. I said you to calculate the tax base of any asset and tax base of any liability. First, identify कि do you have any future tax consequences of paying or getting the benefit? Yes. Create the deferred tax, and to have the deferred tax, you need to have temporary differences. And first identify how much benefit or how much liability you are going to have in future. Then on the basis of that benefit, you need to create the deferred tax. Then you will identify the temporary differences. Then you can know the tax base of asset and liability. Thank you.